Markowitz theorized that everything should have a risk and return trade-off, and that this balancing act could be applied to any asset so long as there was an appropriate measure for risk. Markowitz suggested that an asset's volatility was a good metric to use to assess total risk. In other words, the more volatile an asset's price, the more risk this asset posed to an investor, and vice versa. If there was little volatility, then there was little risk posed to the investor. What Markowitz also noticed was that the riskier assets had the ability to pay off more than the less risky assets. However, riskier assets had a better possibility of losing more than less risky assets. And this is where the risk-reward payoff structure resides. For his work, Markowitz was given the Nobel Prize in Economics, which is probably the highest honor an economist can receive. So on to the math. Markowitz suggested the following. Assets move in correlated and uncorrelated ways to one another. Therefore, some assets would move together in a similar fashion, while others might move in dissimilar fashion, or even a negative fashion. Therefore, Markowitz believed that correlations and covariances between assets were important. He summarized this relationship in a covariance matrix we'll call sigma. Sigma can be thought of as a matrix made up of the time series covariances of each asset. Some assets will have higher covariances, while some will have lower covariances. But this still doesn't answer the question of how much of each asset you should have in your portfolio. What Markowitz also considered was that there was an infinite combination of allocations between assets a person could put into their portfolio. However, there was only a subset of combinations that he believed to be the efficient allocations. These efficient allocations lived along a curve, which Markowitz called the efficient frontier. Allocations which lived along this efficient frontier were considered to have the best reward for a given level of risk. If you've ever thought about dabbling in cryptocurrency but don't know much about it or how much you should invest, then maybe you should look at modern portfolio theory and see if it gives you a better understanding as to where crypto belongs in your personal portfolio. Again, not every asset is right for every investor, but often by diversifying a portfolio across unrelated and uncorrelated assets, investors can add strength to their portfolios.